Let's welcome on board Rupen Rajguru, Head of Equity Investment and Strategy at Julius Baer. Rupen, pleasure to be chatting with you right now and wishing you a very good afternoon. First up, help us make sense of the kind of global moves that we're seeing in the US market. I've read your note that you've come out with, and you also talk about global markets decoupling from the US. What impact could it have on global markets? In terms of emerging markets and also on our markets back home?
Hi, very good afternoon to you. So, as you rightly said, uh, at least after the initial knee-jerk reaction, the global market seems to have decoupled from the US market. And uh, the reason being because the way the entire tariff tantrum, if I were to use that word, has come through. And not only that, but the way every day new and new stance the US president is taking on various subject. So two things are very clear. One, at least the US dollar is on its way down, and which is what is getting reflected in DXY as well. And secondly, there is seems to be a new world order wherein earlier it was a multilateral free trade world, and now it's going to be more of a bilateral trade, and the world will be slightly different than what it was earlier. So in that event, what is happening is that thanks to the US exceptionalism, for last 4 years, on an average, 80% of the overall flows into equities went into the US. But because of this new structure, probably that lot of that flows will get into some of the other countries, including Europe, some of the other Asian countries, India included. So in that context, and if you see all the global markets, Europe this year has done pretty well. Brazil has done well. India also on a relative basis have done well. So that decoupling on the market, thanks to the liquidity, is what we are seeing, and that structure we believe is here to stay. And Since US, if you for last 15 years, the US market and especially US technology stocks has done exceedingly well. That momentum we believe is broken thanks to be it the way Donald Trump has acted in last 2-3 months, and it should, purely from a capital market perspective and liquidity perspective, should be better for other countries, including India.
Right, Rupen, hi, this is Ankita also joining in. Good afternoon. Rupen, a couple of things that you mentioned here. Now, while right now, today and yesterday, we are seeing a bit of a trepidation in the market because of the geopolitical tensions with Pakistan, but otherwise, is India better placed? Because, like you mentioned, in the FIIs have turned net buyers. I mean, the flows have started coming back to India. The dollar index has cooled off, and so has the bond. The US, as far as the US is concerned, the flows might reverse and it could come back to emerging markets, especially India. Are we better placed now, and from here on, once the trepidation in the market is over, because we've seen considerable drawdown also, do you see the markets moving up again?
Yeah, hi Ankita, afternoon. So no, absolutely with you, and what you said is true. But from a market perspective, while liquidity is an important factor which will determine the short-term movement of the market, and that is what we have seen at least in last 2-3 weeks, we have seen, thanks to liquidity, the market going up. But we have to, from a purely India perspective, no, India actually was going through a macro headwind. So last entire year, if you were to say this FY25, probably will land up, nifty earnings growth of 2 to 3%. And we all know the reasons, be it starting from government spending, thanks to elections and other reasons, was not very high for the first 7-8 months. RBI was very, very, I would say, from a regulatory standpoint, as also from a liquidity standpoint, it was pretty tight. And also the other factors of inflation also being high, all that impacted the growth for the economy. All those factors are now reversing. So Indian market corrected because of more of because more of domestic headwind, and now the global headwind which has come through, and then hence the volatility we have seen. So going ahead, we believe that the domestic headwind will recede, and all those factors, be it government spending or from RBI side, we are clearly seeing RBI now focusing on growth and being very easy both on the liquidity side and also a little bit of relaxation on the regulation side, which is helping. And their focus is to get back growth. Inflation has come off. So from earnings wise, probably we will now see the earnings growth reviving, but at the same time we have to be mindful of valuation. So the third part of the apart from liquidity and sentiment, the third leg, which is the valuations. So on valuations, now we are, after the current rally at 24,300 and thereabouts, we are at a fair valuation zone. So yes, can we go to say 25 and a half thousand? Probably yes, but for that, earnings growth should come through, which probably will start kicking in from second quarters of the next financial year. So to answer your question, probably we might, unless and until global things don't deteriorate significantly, and the war and all those scenarios will have a volatility in the market. But from an upside perspective, we don't see a big upside from here. But if there is a drawdown because of geopolitical issues, definitely this would be the market to be bought into.
Also, Rupen, let's focus back home and talk about some sectors. Large private banks have largely been leading the rally right now. Are you seeing some rotation into mid-size banking names? Do you believe that the sector turn could happen or in that direction now? And from the financials pack, would you prefer banking over NBFC given the kind of numbers, especially recently we've seen from the Bajaj twins, that is rather disappointing. What would your pecking order be within the financial space, and do you believe the valuations are justified for the banking names right now?
So, no, banking actually has been the star for last two quarters, and we have been positive on banking and large private sector banks, which has actually played out. So after the rally in some of the top three, top four private sector banks, on valuation, okay, they were in a zone in which they were much below their long-term average, and now some of these banks are getting towards their long-term average, and I think some are actually higher than their long-term average as we speak. So now we have to look through, from a sector perspective. So banking as a sector uh, did pretty well in that environment of tight regulation and tight liquidity, and now that environment is changing, so the growth will come back. So yes, you are right. Typically in markets, after the leaders move, the time comes for the mid and the second tier banks, so to say. So in that space, we like some of the other, I would say, banks, and that would also, I would include some of the NBFCs, where there has been change in management. So some of the smaller banks have got CEOs who were KMPs of some of the large banks. So some of those guys are now doing a lot of changes in the bank and the structure in which they operate. I think we are pretty excited about that. So some of the, not all, but some of the banks wherein we are clearly seeing change in guard and change in strategy, we are evaluating that, and we like those banks. And your question between banking and NBFCs,
Yeah.
the growth definitely we believe would be higher on the NBFC side.
Right.
While you mentioned about Bajaj twins, I think numbers were broadly in line and nothing unusual about those numbers. And in an environment of lower interest rates, probably NBFCs are better placed because a lot of their loan books
Correct.
are fixed. And I think we are more constructive on
Right.
NBFCs vis-a-vis some of those banks.
Right, Rupen. So NBFC is a common consensus, as you mentioned. Like if the interest rates are lower, then NBFCs it augurs very well for the NBFCs. But on that note, thank you so much for taking the time out and joining us. With that, it's time for us to slip into a short break. Don't go anywhere. We'll be back after the break. Stay tuned.